Stocks keep soaring, as investors only want to buy. With what we know about markets, the source of funds should have run dry. It's as if money is falling out of the sky. And it's a powerful market that nothing can deny. So watch the show, and I'll tell you why.
Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone gliding, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. Hopefully, lots of great ideas and opportunities for you throughout the show. Well, the stock market, after an incredible year in 2017, after an incredible 8 years since the low in 2009, has an incredible start to the year. Even more incredible than most bulls could have guessed, with the first 4 days of the year seeing the market soaring on the upside. Investor confidence in the Trump agenda has been clear, actually for the whole last year. And, President Trump has not missed a single opportunity to let us know that either. But there's more to it than that, and why this market keeps rolling onto the upside and where that source of funds is coming from. We're actually going to show you and talk to you about that as we get a little bit later in the show. For the stock market this week, well, we've had a pretty sizable gain going on, and it has been really steady. Let's take a look as we look at our 60-minute chart of the S&P 500 over this last, 4-day period. See something kind of obvious there? Well, certainly, as you see an uptrend in there that has gone, unscathed all the way up. Of course, Monday was closed and for New Year's Day, but Tuesday we saw the markets move up. Overnight markets were mixed. We're waiting for the U.S. markets to open, and there was a last day swoon right in here. You could see that bar right over there as the market moved sharply lower for the last day of the year, but that didn't mean anything, and we saw a big recovery. The NASDAQ up 100 points on Tuesday plus as Amazon jumps. They reported that for the year they shipped over 5 billion packages through Amazon Prime alone. So that was lifting the NASDAQ. NASDAQ stocks were playing out strong. We had this big gain here on Tuesday. Wednesday we were waiting for the FOMC minutes. Construction, spending, ISM, all strong. And the techs continued to drive upward as the market moved up sharply again. FOMC minutes came out. They were completely befuddled. They have no idea at all. They're still talking about 3 hikes for 2018. The Hawks and the Doves did battle, however, and they were concerned about that flattening yield curve and confused overall. They expect that the tax cuts are going to raise the GDP, and that's going to be motivation for them to keep raising interest rates. Interest rates going up, believe it or not, are a factor in the strong stock market we're seeing right now. And again, I'm going to tell you about that in just a couple moments. We saw on Wednesday the ADP, Thursday, ADP numbers were strong, up 250,000. That gave a lift to markets, and we saw another update. The first 2 hours the strongest, and then it kind of just moved sideways, as you could see right in there. And Friday, the market's up again, not quite as strong. You can see as we've traveled up this rising range, this channel, all the way during the week. And now we've been kind of trading above it here on the lower end of it. got to make you wonder as we get into these last couple hours of the day whether or not the market is going to be able to hold that uptrend that we see. Payrolls up 148,000 was reported. That really was a disappointment, but you could see the market only blip down for a couple of seconds and then turn back to the upside. So plainly what we're continuing to see is a market that, well, just keeps building on its upward momentum. Just an incredible amount of strength as we see the markets continue to move to the upside. So there's more to this stock market rally than the tax plan that we see or the prospects of infrastructure spending coming, giving the market more stimulus. Just a reminder that world central banks have been involved. Every stat that we look at is suggestive of the fact that the market should have run out of gas long ago. Over months, I have brought you continuously those statistics which have shown the fact that margin debt is at records, that net free balances in brokerage accounts is at record lows, and that the net liquid funds that are in fund managers' hands are at record lows. So the question we keep asking is, what is driving the stock market rally? Where is the money coming from? As if it's falling out of the sky. Well, I guess in some ways it has been. Just a little bit of history as we talk about the Fed. The Fed and central banks around the world, they created the financial crisis back in 2008, 2009. That's with their bubble bust policies, where they continue to stimulate, create false sense of rally in the markets, want to give us a sense of the wealth effect where we all feel richer and spend more money. And then, of course, they start to close the spigots down, and then the markets move lower. We saw that happen in 2000 peak. We saw that happen in the 2007 peak, which turned into the financial crisis, of course, as their policies have totally caused all of these upside bubbles and the busts that we have seen. The 2008-9 crash essentially was preceded by extraordinarily easy money. And then when the crash came, money got very tight. Before the crash, you could get a mortgage for 125% of the value of the home. That's right. You buy a couple $100,000 home or take a couple $100,000 mortgage, they could possibly give you $50,000 cash in your pocket just to do so. So that's how easy money was, and the reason why the mortgage bubble was created, the housing bubble was created, and the massive level of unaffordability of homes brought that crash. And then, of course, the banks were highly leveraged and everything came apart. We all know that story. So what happens then is that you get these record low rates, and you get the banks go from very easy to very tight, and then there's no more reward for banks to loan money. In other words, they can't find qualified buyers anymore because the lending standards got so tight. And what happened was that, well, they stopped loaning money out. And money was essentially in their reserves. It was just sitting there in the banks, and they were happy because the Fed was paying them 0.25%. The banks were getting rich and reflated by that policy out of the Fed. Then business, of course, they got into this period of financial engineering because, well, money was, cheap. They could borrow money and buy up their own stocks. So they did that, and at the same time, they avoided capital spending. So CapEx flattened out or got weak, and again, the economy is not growing at that point. So there's no stimulus for money. Money velocity just absolutely crashes when that happens. And money stuck in banks, money not being spent, borrowers not having good enough credit to be loaned to. That's what a liquidity trap is. Money gets stuck, essentially, not moving through the economy, and the Fed created the liquidity trap that we were in. As a matter of fact, Japan has done that now for almost 3 decades, and that's their problem, why they can't get any growth and why they still have negative interest rates. So under that environment, of course, investors really scared. They don't know where to put their money, and the stock market going up, and it seems like the stock market should correct. So the retail investor, the average investor, just out there keeping their money in treasury bonds, keeping their money in the bond market. We saw incredibly low rates as negative rates throughout Europe, and countries that are in incredible trouble like Spain and Greece actually having much, much lower rates that they were able to borrow at. High-grade bonds, those really high yield bonds, low grade, had incredibly low rates, big rallies in there. So the money was moving into the bond market. That's what was going on. And again, pretty much trapped in that area at incredibly low rates. That's how the central banks were able to sell money at negative rates, sell bonds at negative rates, or the United States to sell treasury bonds at between 1% and 2%, and just incredibly low numbers, historically low numbers, money in the bond market and stuck there. But now things are changing. Fed raised rates 3 times off in last year. They're projected to raise rates again 3 times in the next year. And stocks are soaring, and the fear of missing out is growing, and investors are chasing. So you've noticed the weakness in the bond market now, and the bond markets around the world. That's what's going on. There's a huge change of investment policy, and money is being reallocated. The bond market is nearly twice the size of the equity markets all around the world. So the bond market is a huge source of funds. And if there's money falling out of the sky to buy stocks, it's this allocation switch. It's the money moving out of the bond market as we see bonds moving down, and a lot of money then becoming a resource for the stock market, fuel for this stock market moving up. This liquidity trap is breaking down right now, and when that happens, of course, that's an inflationary scenario. So bonds will continue to fall, commodities will continue to improve, and the stock market will continue to have this source of money. A much greater source of funds than, maybe they had before. And so the fact that we see these stats that there should be no more money available to the markets, the money coming out of the bond market is what's driving stocks. That's what we see going on right now. It's an incredible thing that we're seeing. And as the rally piles up on top of the rally, and we keep seeing record highs that, even the bulls couldn't have guessed that we would get to this level. Here we are in 2018, and as I said in my year-end show, 2018 will see a correction. We're going to see a pretty good size dip in there, and I think it's into mid-year. But this won't be an end to the bear market, and they're just going to keep wanting to buy the bigger dips. When those start to come, volatility might come up, but truth is that there's no bear market here yet. There's a lot of resources coming out of the bond market into the stock market, and we're going to see bigger volatility, but and a correction. But we're not likely to see anything that is anything that looks like a bear market in 2018. That's where the source of funds are coming from, and it's likely to continue. I think the commodity markets are going to be the best, actually, as the high-priced stocks start to get sold here that did well over these last few years. That's it for the opening segment, and I will be right back with the best and worst stocks for the week. All right, this is the best and worst stocks of the week. What I do is I look at the 320 stocks that I follow in ETFs in the stock market, and then look at the stocks that have the biggest gains or biggest losses, and try to pick out of those the ones that might be the biggest opportunities looking forward. One of the stocks that I talked about, maybe it was a few months ago, saying that this stock looked like it was, to me, being reborn, was BlackBerry. BB is the new symbol in there. Remember, it used to be BBRY. And they changed the symbol, they changed the company. It used to be basically a hardware company, and they were the last ones really to hold on to the actual physical keyboards on the phones, right? But then they decided that it was a lot better to go into software, internet security, phone security, those things. And BlackBerry is a reborn stock. This was the biggest gainer of the week in here at a 20%. Look at that upside move. We discussed this, as I said, when it was really back in the 910 area. Now it's down, and now it's up to 1377 in a giant week. I'm going to, first of all, you can see the cyclic patterns that are in here, as these are the ideal cycles based on the cycle brackets, and the way they actually resolved are what we have drawn right over here. So that's a good look at BlackBerry right there, and it's in this next rising phase right over here with no sign of a top. It's pretty hard to project where that top is going to be. I actually think you could buy a dip in here. Take a look at BlackBerry on the daily chart, and let me just break this down for you right over here. And basically you can see that it's, when it moves far away from the slim ribbon, it then tends to pull back. We're guessing it's going to get a pullback in here under 13, and we think that would be a significant buying opportunity when you look at that. BlackBerry, 20% gainer on the week, and we think a very solid stock. I wouldn't be surprised to see it as a $25 stock down the road, as they start to prove that their business model change is working. Steel stocks got pretty good gains this week. The biggest gainer of the week was AK Steel. That's up 13% on the week. This is a stock that we thought was going to be one of the underperformers in the stock group. That actually has not been accurate. The percentage gain in there has been good. There's that last cyclical peak right over there, and you can see it's not quite to it yet. And the patterns in here are suggestive of the fact that that might be the place it stalls, right around $7. But overall, we think that there's a big base being built in here. And if we're right, and based on this trend right over here, we would expect that it's going to pull back in here for about the next month and a half, and then likely after that do better. So we're thinking maybe $7 here in AK Steel. One other steel stock I want to look at is Steel Dynamics. Look at this one surge in here, as this has moved way up above where our projection was right there, as it really broke out above that pattern right there. That's a good looking stock and a big gainer on the week. Also, want to look also at Allegheny ATI. And you can see this one pushing to the upside. Also, this is all the infrastructure play. And just as buyers and stocks believed that the tax plan was coming, buyers and stocks are believing that infrastructure spending is coming, and they're getting ahead of it. And that's why we have this rally going on right in here. ATI, Allegheny up about 8% on the week. U.S. Steel up 6%, Nucor up 4%. Basically, what we're looking at is, the potential for small pullbacks and then continuations of the rally on the upside. Next stock we're going to look at is in the bill paying and payment category, and that is Square. Now, Square had a huge rally based on Bitcoin and the fact that they were working up their software to be able to accept Bitcoin, and that there was a likelihood that there would be a big gain for them in the fact that they were getting set up for that. Problem is that, well, a Bitcoin adoption is a long way off. It's a long way before you walk into a store and say, I'm going to buy this pair of jeans or pay for your groceries in Mariano's using Bitcoin. So adoption is really far away, and nobody knows which currency it's really going to be that is the winner out of 1,300 plus currencies that are in the cryptocurrency category. There's going to be a huge shakeout in there, and that's not going to be good for Square when that happens. As a matter of fact, you can see in here, after gaining 12% on the week, or 13% now, you can see it's getting up into this resistance zone. I'm thinking that it's going to stall there. Note that the cycle pattern and the projection in there was suggestive of the fact that it was going to move down through this period and then move up through this period. We got the big decline. It falls from 50 to 35. That's a massive 30% drop into the intermediate support zone. Here's the intermediate resistance zone, and maybe it makes 41 to 43, but we think that's the part where it's going to fail from, and our projection has it coming back down again, probably under $32, once it stalls up in here in this resistance zone. So Square gets a big rally, bounces from support, but we think more that there's big trouble above and that this rally is likely to stall. Semiconductors got a big boost this week. Intel had problems with security issues, and that gave a lift to AMD and other stocks in this group of semiconductors, and Intel, which was down only a couple percent on the week, not that big a deal. These stocks actually did better. So nice 12% gain in here, but it's not great. I'll tell you why it's not great. So I want you to see each of these cycles. Notice how the cycles follow these patterns on the bottom, right? Those are the idealized cycles, and that's how you get an upward trend. When the trend is ending, you get the double top. You could see that right there. And then to prove the downtrend, it fails, doesn't make a new high, and then comes down. See how these cycles were, how they actually traded versus the ideal on the bottom in here. Then you get into the next rally phase, and you get, resistance is somewhere right up here. I cannot see, Intel not fixing their problem, and I can't see AMD doing a lot better. This just does not look like a great opportunity to me, and I think we're going to see AMD in the first, few months of this year moving down towards or below that $10 number again. On the other hand, Micron is one we've loved, and we thought it was going to be, again, one of the best stocks for the year. It's on our list of best for 2018. I'll have that on all of the charts. I'll update all of those, let you know which are the best and riskiest. And you could see it just absolutely exploding on the weekend here, also gaining a good solid 9% or so. And we think it's going to get up into that target zone right up over there above the high. I think you'll see it at 50 to 52 in this move. The cyclicality in here is super. You could see that. You see the support at the 34-week moving average, support here at only at the 38.2%, so it hardly could fall. And now moving up again, Micron, a super strong stock when you look at that. Next one we're going to look at is Alibaba. This stock moves again to the upside this week, and I would say we're not thrilled with it when we see this. As a matter of fact, it's got a very toppy formation in here, and while it has a solid gain on the week, we think it's up into this area of resistance and has begun the process of topping and rolling over. So why do I believe that? Well, you can see in here again, follow this, 1, 2, 3, and 4 solidly rising cycles. You can see that. This one clearly rolling over and has about a month to go before this correction is over with, or top formation is over with. So we would look for this to roll over, well, any minute, and fail in this area of fib extensions and then move back to the downside. So it gets this move to the upside this week, pretty strong, but we don't like it. And that would be I think, an area to lighten up if you were long this stock, or to consider short positions in Alibaba. Next, a couple stocks we're going to look at are in the natural gas category. Now, natural gas had a spike based on this bomb cyclone and the frigid weather that came across the country, and then fell back down hard. We've been bearish in natural gas. That's the commodity. However, natural gas stocks are much better. And we did a video this week on Thursday, and if you're not a member, I encourage you to be so, where we took a broad look at the whole energy sector. In fact, 4 subsectors, looked at the ETFs, and and looked at, the natural gas stocks. So 21 total stocks, and great analysis on there. And I think that it would pay for you to become a trial member. I'll tell you a little bit more about that in a moment. And then be able to watch these videos that we produce that are so informative. I want you to take a look here as we switch to APA, which, despite the fact that natural gas itself failed this week, is quite strong, has a good gain on the week, about 8%. Here's APA, which is Apache Corporation, and you can see it's now moving up into some resistance, but note our projections in here, getting up past this intermediate resistance into the major resistance up here to this fib. We're actually projecting near 54 on this stock, as it looks, just to us, great, as it makes a little bit of an early low, which is bullish, and then just soars on the upside. So money moving into the energy sector. We think that if it's going to peak, it's, some of them look like they need little pullbacks, but I don't think that there's going to be a major peak in here probably until the springtime. So APA, a monstrously powerful looking stock, as we believe a base was formed. This is the base right in here, where it has this slight little uptrend. It then gets all of the sellers out, new owners in, and then breaks above this level. That's a key level up there. If it gets above 46.75, I think it's going to break out in a big way. So Apache, excuse me, with an 8% gain on the week, solid. Another one in this category is Hess, and you can see in here exploded to the upside in here in what is turning out to be quite a bullish pattern. So you see these patterns right in here where it makes a high and then comes down and gets below this low. That's bearish, and what happens is the next rally fails and goes to a lower low. But when you have a rally that then bases way above and then get the next strength, man, that is a powerful sign. I don't know if this fib extension right there is going to stop it. I think that this is very strong, and I think that the natural gas stocks are very strong. You're going to really want to watch that video where we talk about the 21 energy stocks. Plus, we look at OIH, we look at XLE, and we look at oil, and it's a very informative video, and we do a lot of teaching around cycle analysis, so you really ought to watch that. Last stock in the best of the week that we're going to look at is Netflix. This stock had a giant week as buying came in, and some of this may be related to troubles that Roku is having, and some of it may be related to just an extraordinarily bullish pattern. Now, here you see the same thing, this upward rising pattern that's moving up this 34-week moving average, continuing to give strength, continuously hits supports and makes the cycle bottom. All of those hitting supports and making the cycle bottom. You can see it did it here, 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 and here. So this rally, exactly on time, gets into the target zone, which is between the 78 and 100% fib extension. All of this is bullish, but why does it then appear in our riskiest stocks of the year? Plainly, it's valuation. They can't afford to miss. Their content is really expensive. Their forward PE on incredibly optimistic earnings is at 87. We think that this area is a sell area between this 210 and 220, and that could very well be the high of the year for this stock. That is a look at Netflix, which gains some 7% on the week, and what we think is likely in the group of the stocks that have the greatest risk. That's based on valuations. Now we're going to move over to what is a pretty feeble list of the worst stocks of the week. All right, for the worst stocks of the week, well, there's not much to report here. Before I tell you what the worst stocks of the week were, I just want to tell you about our specials that we're running right now. I think that it's a great opportunity. If you like these charts that you see, these charts are prepared on the platform of our preferred broker, which is TD Ameritrade, and that platform, of course, is Thinkorswim. We do all of our work on there. It's very unique that they have this ability for us to do all of this work, save all of our drawings and all of our cycles, and then share them with you. So we do that for 320 stocks. What we share is the 80 best traded stocks, futures and ETFs. You don't need to really go outside of that list for your trading, but if you want to, and if you're a level 4 member, you can just ask me for analysis on any of those stocks, other stocks, and I'll be glad to let you know if I have that and send that to you. Level 4 members also get our rankings and trade setups on those 80 stocks. We put out trade setups every week. We look for the most favorable locations for trade setups, and we have a very, very good risk reward as far as the successful ones versus unsuccessful ones, somewhere close to 2 to 1. So you can see that stat on the front of our website. And also, of course, you get our 250 plus videos, and we continue to do videos every single week, doing 4 a week, including this show, so you'll continue to get good updated information. And if you want to be a level 4 member and try it out, you'll get 4 weeks of these charts and all of that other incredible information for half price for the month. Just try us out, $64.50. It's just an amazing value, and you're going to learn so much in that month. It's unbelievable. So send me an email, slim@askSlim.com. I'll send you that special link for the level 4 trial membership. And if you're not on Thinkorswim, you don't use TD Ameritrade, you can get a special for level 3. I'll be glad to send you that link also. So I wanted to let you know about that because it's such an incredible opportunity, and I promise you will learn a ton from all that information. Let's get to the worst of the week right in here. As we look at, well, not much. If I have to dip into the utilities to tell you about the worst of the week, then I would say that there's craziness going on here in this world right now. Of course, we know that by what we talked about so far, but explainable, as I told you in the first segment. Take a look here at XLU. You see the breakdown here? First of all, it moves under that 34-week moving average. Second of all, it moves under that last cycle low, which was bearish. Here's the cycle low. You could see where these lows come in. So this was a modest low right there. This was a well-timed low. And the next low is due right over here in March. So you can see our projection right here. So it breaks under this level, gives you the bear signal. It actually gave you a bear signal right over here. You could see that. And momentum has turned negative in here. I haven't been showing much in the way of daily charts, but you can see right in here where the momentum turned negative. This is the slim ribbon, and you can see right there that red arrow. What happened after it turned negative? Just an absolute collapse and moved under that 89-day moving average. So here's that weekly pattern, a low due out over here at the end of March. I don't think that there's much in there to talk about other than negativity. ComEd down 5% on the week, Southern Company down 4%, XL down 3%, and XLU down about 3% on the week. So that's a pretty bad picture. Of course, when bond market declines or interest rates go up, it's not good for utilities because they're massive borrowers. And as their costs go up, the stocks go down. It's pretty typically historically. So that's what we're seeing in there. Retail had a few stocks that got hit. The problem was that they got massively exuberant during that Christmas season when they saw strong Christmas sales. Of course, most of those, the benefit of that went to the online sellers, and some of these other big box stores got a pretty good dip in here. Another piece of bad news is that Sears is adding to the number of stores that they're closing, 11 more, and that makes it over 100 that they're going to be closing in the late winter, early springtime. So that company in pure meltdown. It was kind of a race to the basement between Sears and JCPenney. Our target in JCPenney was 2. It got to 235 last year. That was extraordinary. And now Sears looks like the one that's going to run out of money first. So we'll see what happens in there. And when you peel back that many stores, on top of what they've already been doing with selling real estate, then that's a big problem, and they're probably going to be gone. In this category, the stocks that had done really well that are now rolling over, Gap stores, they fell 5% on the week. You could see that in here. Our projection is for it to decline to the breakout level, which is to about $30 between now and the middle of March. That's the timing that you can see right in there. Macy's down also about 5% on the week. You could see it rolling over from that resistance level right over there. We have kind of a stair-step downward target over here, also goes to the end of March, beginning of April. We expect it to get to that support zone under $22 in Macy's. AEO, one that was extraordinarily strong. Now, note these peaks over here. Those are cycle peaks right there, and note it gets up into that cycle peak resistance range and gives you a textbook evening star. It's not likely that we're going to see that support hold at the 23% fib. More likely it'll get down to under 17 right over there. And again, that points to beginning of February when that low is due. So with this pattern that you see right there, I think it's a sell, at least for the near term. Likely to see more pressure in there and maybe more pressure in retail as a whole. Telephone, there's another classic looking textbook engulfing pattern right there. It falls from that exact cycle peak level. You can see that, which was a past resistance zone. Here's your sell pattern right there, and here's your support under 37, likely to get there into the last weeks of March is the way that's timed right there. Airlines overall, though I think they may be decent for the year, JetBlue had a pretty good pullback. One of the many companies that you got to give credit to this, that they're giving $1,000 to each employee based on the tax plan. And I think it's going to be a buy soon. Here's that JetBlue chart, which I think is textbook. Cyclical patterns in here. You're going to love this because I think it's screaming a really good opportunity here in JetBlue. What we want to look at is the cyclical patterns, and where you see the nested patterns, in other words, where you have two cycles coming down and bottoming together, that brings pretty good declines. You can see that right there. And now we're in one of those periods. So the top here is in, but there's only about 2 or 3 or 4 weeks left to go in here. So we don't think there's going to be a big decline. Between 19.5 and 20 is our buy zone right there. And then we think it's going to move up, and this will be a very bullish cycle. In other words, this is configured positively, and then the next big rally comes. That's what we see right here, and we think there is a good opportunity there. So JetBlue, though it's down on the week, we think it's a good opportunity on the long side. That is our worst for the week, and coming up is our short-term view. All right, short-term view for the coming week. Haven't done this actually in a number of weeks because we have been either on vacation or doing our year-end show. So this is a return, and we're going to look at things a little bit differently than we have before. While cyclical analysis is important to us, long-term or short-term, it also is important that we give proper balance and weighting to other indicators, and momentum indicators, which we have several of, are really important to focus on. And we're going to do more of that starting in the beginning of this year than we have in the past. If we did that last year, there would have been a lot of periods where we were looking for market corrections that we would have really said momentum is going to prevent much on the downside. And that really proved to be correct. So what we are going to look at is light crude, the dollar and euro currency, gold, silver, the bond market, and the stock market. We look at our daily charts in here. And light crude is the one we're going to start in. This is an unusual one because what it shows us is that there's a skew going on. The very cold weather, the bomb cyclone, the frigid weather across the country, pushing up heating oil prices. And when the products go up like that, it is a benefit to the to light crude itself, which is the source for cracking. So you can see in here we have positive momentum. The positive momentum actually came into play way back before this chart over here. And you see this slim ribbon positive all the way. That's been just a great signal that momentum is really the focus here. We have a pattern in here that's suggestive of a pullback. That's why we have that pullback there. We think it'll be minor. We're looking for it to get into the slim ribbon again, maybe get down to the $60 area, and then begin to bounce again. So momentum strong. The rally may be overdone, so the pullback down to $60, maybe a little bit lower, but then we think it'll be moving up again. The dollar has been extraordinarily weak, and that looks to us like that pattern is near a breakdown. You can see right over here that cycle low support. We have reasons to believe this is not going to hold, and if it doesn't, then it should be another downward acceleration. We're going to look for a small upward attempt that fails. Basically, momentum you can see negative. Our basic momentum indicator on these charts are slim ribbon. We also have other ones that we look at momentum-wise: mobile breakout bands, Hull moving average, our OBI option bias indicator. Those are all momentum indicators or market condition indicators. So this one negative, you could see it accelerate to the downside, the widening of the ribbons, which is important to understanding momentum. This says to us that there's a pretty good chance that we're going to see a breakdown. So maybe an attempted rally from that area that doesn't hold. The euro currency is kind of tipping us off of that breakdown when you look in here because it doesn't have much time to fall, maybe 2 days. We're going to look at Tuesday or Wednesday as the corrective period ending and then moving up again. And at 56% weighting of the dollar index, well, that's saying that the dollar is likely to move to the downside again. So we're going to look for a small dip in the euro potentially and then up again, inverse to what we see for the dollar. Momentum weak in the dollar, momentum strong in the euro. And likely if we get a dip in here, it is a buying opportunity in the euro. Gold market /GC is the next one we're going to look at. And you can see this looks like the euro, right? Because it's inverse to the dollar also. See this long upward trend, the bullish, the positive momentum that we have in here. It calls for just to move down to support. We'd love the opportunity to buy it at 1303 or lower in these next several days, hoping for that pullback. But the buy the dippers are in here every day that it tries to dip. Then the buyers come back in. You could see right in here, right in here, and right in here. All those dips just couldn't hold the downside. So how are we going to get down to 1303? That's the question. I'm hoping it can, and then if it does, that would be the good buying opportunity. But in the next 3-4 days, it's going to run out of time, and I think it's going to be moving up anyway as the momentum on the upside will gain strength again. So strong look in there in the gold market. We're going to look for a dip that doesn't hold, and then moving up again. Maybe a choppy or weak in there. Here you could see silver. It's got a pretty much similar alignment in there, and again, looking for a little bit of a dip. Love to buy it at about under 1690. Right now from 1726. I don't know where that selling is going to come from. It can't hold the downside either, as the buyers just keep coming in. Momentum strong in there, really positive momentum, and I believe that this momentum indicator is suggesting that any dip will be temporary in the gold market. The next one we're going to look at is the bond market, /ZN and ZB. They look pretty similarly negative. The 10 years are more negative than the 30-year because of the flattening of the yield curve. This is very close to breaking down in here. It's kind of got about 3 or 4 days of moving to the downside, and then we think it will get into another failing rally period. The 30-year is looking pretty similar. Note the negative momentum in here, and it's been negative momentum through this whole period. You can see that. If I go further back, we can see where the momentum turned negative, and that was way back over here. And since then, it has been just continuously moving to the downside. These momentum indicators are important. Add to that these cyclical rhythms, and you get some more downside and then a failing rally there that you can see in the ZNs, the ZBs. A little bit better pattern. As you can see, it gets into minor support and hold. This one we think probably gets down to about 51.12 or a little bit lower over these next few days, and then tries a feeble failing rally again after that. So we're going to look for a dip down 3-4 days and then coming back up. Momentum negative, the trend very visibly negative, and we're likely to see over this next month this zigzag downward movement that we have in here and some lower prices. So a bad picture that we see there in the bond market. As far as the stock market, well, now the patterns are clearing up, as often happens as you get past the end of the year. The real driving force is the Russell cyclical pattern, which we have now overlaid onto the major indexes, the S&P 500 and the NASDAQ. You can see that right in here. This looks to us like, with these patterns pretty clear to us right now, that there's a resistance right here at 2740. That's this 100% fib extension. We think that over the next week it's going to peak in here and then begin to roll over. Again, you can look at the upside, the powerful upside momentum. Now take a look at the slim ribbon. All the way back from here is where it turned positive. That's 2440 or so, and rallies all the way up to 2730. And you can see it moving up, this momentum indicator, the slim ribbon right there. And then it hits this cyclical bottoming area right in here. Right there on the slim ribbon and move sharply up, right here on the slim ribbon and move sharply up. So the question is, can it get through this level? Man, if it does, then the next level is significantly higher. We're going to guess it's going to stop in here after this big surge this week and begin to roll over. But we're not looking for anything significant on the downside, momentum still being this strong. 2740, the important number. We'll see if it can move through there. We doubt it. We're going to call it a small down week in here, kind of choppy, not giving up a lot of ground, and the buy the dipper is still in there also with this positive momentum. NASDAQ, NDX. Again, you see the same thing. You could see the positive momentum. It actually neutralized right over here and then turned positive again. And again, you can see the old pattern right in here and the driving dominant pattern right in here right now. You can see how all of those lined up just really well. So now we have, again, this positive momentum. You know, when you look in here and you see the distance from the 13-day right there, this is one of the reasons we think that that's an overbought signal. Every time it gets far away from the 13-day, it then gets to one of these corrections. Well, this is the furthest it's been from that 13-day moving average, the center of the slim ribbon. So that's one of the reasons we think it's going to be rolling over this week. And we're going to call again for a modest down week. This 100% fib extension is at around 66.83, about 42 more points. I don't think it's going to get there, though it might get close before this rolls over. And we're going to call it a choppy, maybe very modestly down week. And as you can see in here, the risks will pick up the following week. This week, not. More like a rolling over, we think, and more of a range-bound, choppy look. Now, when you look at the VIX index in here, this is a pretty important area on the VIX. So what this shows you is that we're in a little bit of a bouncing area in implied volatilities, but we don't think that they'll last. And out over here in the middle of January is more the time period that there's a possibility for a jump here in implied volatilities. We just expect a little bit of an uptick in here and then pulling down again, maybe getting up to 10 implied volatility and then coming back close to 9 before we can start to move up again. So that's a look at the implied volatilities and showing us that it's not quite time for the stock market to turn down in any significant way. You can see that our focus is much more now on momentum, and I think that's the important thing to keep us on the right side of the market. The market will tell us when momentum issues are breaking, and until then we have to trust in what the market's telling us. That's it for Market Week this week. I hope there was a lot of good information for you in there, and I want you to be incredibly careful because it is so crazy out there. And we're always wishing you great trading.
Well, I'm going to sit